Welcome to Chapter 6 of our Business Resilience Program, where we explore funding fundamentals for sustainable growth. Cash flow issues can surface without warning, often due to weak working capital management. Strengthening it supports stability and long-term growth. In this chapter, we explore financing options and the key factors for structuring funding to suit your business now and in the future. Effective cash flow planning is critical for business success. A common question is, what does the company need to fund? And how much? A business needs funding at every stage, from setting up and get ready to operate, to doing the work, delivering the outcome, and waiting to get paid. Beyond daily operations like payroll, rent, and utilities, businesses need funds for infrastructure and fixed assets, materials, loan or debt repayments, taxes, and capital expenditure. Also, do not overlook working capital as it keeps your business moving. Understanding and managing these elements ensures smooth operation and financial stability. If you foresee a funding gap, it's time to assess how much financing your business truly needs and to determine the type of funding required. There are many financing options available in the market, including equity financing, debt financing, hybrid financing, internal financing, and private equity financing. It is essential to assess which option best fits the business purpose. In the next segment, we will dive deeper into the two most common financing methods, which are equity financing and debt financing. Equity or debt, what's right for your business? It depends on your goals, cash flow, and risk tolerance. Debt financing is funding from financial institutions with defined terms. It's quicker to obtain and ideal for stable cash flows, but repayments are fixed. Equity brings in investors who provide capital and often valuable expertise, but it also means sharing control and future returns. Before choosing debt or equity, ask, can I afford repayments? Am I ready to give up decision-making? The right funding drives growth. The wrong one can cost more than money. How you fund your business shapes its future. But do you really know the cost? Let's look at a simple illustration. Imagine you own a small bakery business and want to expand by opening a second outlet. You need $100,000 to do this. There are two ways to obtain the funding. First, debt financing, meaning you borrow from the bank. The bank lends you $100,000 at 5% interest a year. That means you pay $5,000 in interest annually, no matter how well your bakery performs, but you keep full ownership and control of your business. The key consideration: if sales are low, you still must pay the $5,000 interest, which can strain your cash flow. Second, equity financing, meaning you secure an investor to invest in the business. An investor offers $100,000 in exchange for 30% ownership of your bakery, along with yearly profit sharing or dividends. There's no interest to repay, but the investor receives 30% of your profits indefinitely. The key consideration: if your business grows quickly, they take a significant share of that success. When financing your business, knowing the true cost of debt versus equity is key. Debt has a clear cost, like a 5% interest. Equity might cost you 30% based on investor return expectations. If you're confident in fast growth, debt may be cheaper. If growth is uncertain, equity offers flexibility without fixed repayments. Putting in a simple analogy, debt is like renting a car. You pay monthly, no matter what. Equity is like a partnership. You share the profits when the business is profitable. In a nutshell, choose the option that fits your growth potential and your ability to manage pressure. Funding isn't just about choosing debt or equity. It's about finding the right balance for growth and stability. Start with your risk tolerance. Can you handle regular repayments, Or is equity's flexibility better? Check your liquidity and consider a funding mix of debt and equity. The right blend offers flexibility, control, and capital. If strategic ownership and control matters, equity can feel costly. But if capital is key, it may be worth the trade-off. Align your funding structure with both short-term and long-term goals. And when talking to banks, be clear about your plans and repayment strategy. To wrap up, start by understanding your financial needs and risk tolerance. From there, choose the right mix of debt and equity to support both day-to-day operations and future expansion. It's a simple way to make smarter funding decisions and ensure your business maintains financial stability. Stay with us in the Business Resilience Program as we dive into mastering working capital in the next chapter, where you'll learn how to strengthen liquidity and keep your business moving with confidence. If you would like a summary of the highlights of this chapter, simply scan the QR code on your screen to download your copy.